If a company is to survive and flourish, if it is to grow and expand its markets, it must obtain capital to accomplish these objectives. It simply cannot live hand to mouth. It must obtain more than merely temporary shots in the arm to improve its financial position. The amount of funding it requires to buy or build new plants and offices, to invest in research and development, to purchase new equipment, to acquire land for a new facility, or to upgrade or computerize an old facility, the amount of money it requires to do any or all these things is substantial. And the implications for the organization of these financial decisions must be carefully weighed. Capital is the catalyst for progress. Effective management of this capital asset is a key to business growth. Hello, I'm Alex Burton, and this is the Business File. Our program today is on the management of long-term business funds, and we'll talk about the need for funds and the importance of acquiring them. We'll discover where long-range funds can be acquired and what factors have to be considered when choosing between various sources. And we'll examine the impact those choices have on a company's progress. First, we're returning for a second visit with Joseph Vinceau, Associate Professor of Finance and Business Economics at the University of Southern California. Professor Vinceau, thanks for letting us come back for another conversation.
Thanks, Alex. I'm glad to be here, too.
The last time we visited, we talked about the need for funding in general and short-term funding in particular, but now I'd like to focus on the role of long-term funding. And perhaps we ought to start with a definition. What is long-term funding?
Long-term funding is the acquisition of capital to invest in long-term projects, in the expansion of the company, to produce the primary goods and services that the company generates.
This next question might seem a little obvious, but I'm building towards an area that's not. Why is it important to plan for long-term funding?
Well, if you don't plan for long-term funding, then you're going to find that you may not be able to get it in the amount you need or when you need it.
Professor Vinceau, what do you need to consider in long-term financial planning?
Well, the key part of long-range planning is to know what funds you're going to be needing, where you're going to be needing them, that is, what type of investments are you going to be making? Is it going to be plant and equipment? Is it going to be current assets or whatever? And then, second of all, where are you going to get it? Are you going to be using short-term? Are you going to be using long-term?
Fine, but what else is involved in long-term planning besides sources of funds and uses of funds?
Obtaining long-term funds is of no value if you don't have projects to invest them in. But finding the projects is not the end of it. What you need to do is then to decide which projects are you going to be investing in. And once you have made that decision, you can't stop watching these investments. You have to watch that costs don't get out of line. You have to watch that the activities go ahead as you planned. And some of these may take as long as 4 or 5 years. Some large plants take 4 or 5 years to construct. And then the key part of long-range planning is to find out how well you did. You need to do what we call a post-mortem to see whether or not you know the process that you went through was worthwhile. The long-range planning that you do has got to be generating appropriate results. And so you not only do you have to do it and watch it, but you occasionally have to go back and see whether you're doing a good job at it.
Okay, I think I've got a feeling for the critical nature of long-term financial planning and what you need to go through, but what are the basic sources of long-term funding?
Well, basically there are two types of funds. There's debt, and then there's equity.
Would you define debt funding for us?
Debt financing really refers to the acquisition of funds from outsiders, outside of the corporation. They are owed over a period of time. There is a time in which it must be paid, and you must pay a periodic charge on that called interest. There are many types of debt, but basically they all have that same form.
And what about equity funding?
Well, equity is somewhat different. Equity is considered the ownership of the organization.
Well, let me conclude our conversation here, Professor Vinsel. Thank you so much for allowing us to visit once again. It's been a pleasure.
Well, thank you, Alex. I enjoyed being here, too.
Later in the program, we're going to visit two companies which took advantage of both debt and equity long-range funding. But first, let's take a look at a financing scenario. Choices, uses, or projects, as Dr. Vinsel would call them, and the consequences of the various options.
Every company, if it is to survive and prosper, must seek long-term funds to finance its long-range goals. Long-term financing is generally needed for massive long-range projects. Projects such as the construction of a new manufacturing plant or a research and development facility, the introduction of a new product line, or the purchase of new equipment. There are two basic sources for these long-term funds. One is debt financing, which might be long-term loans or issuing and selling bonds. The other source is equity financing. An example would be raising funds by selling stock, common or preferred, in the company. Which approach, debt or equity, a company selects and uses depends on the priorities of the organization and the consequences for the organization. Each approach involves different obligations. Each impacts differently on the company's progress. Making a decision regarding which funding source is right for the project being funded is extremely complex. But there are basically 4 decision-making factors. First, flexibility to the company. Some choices entail legal obligations which may restrict the company. A bond may have restrictions which require it to pay interest periodically, regardless of the performance of the company. With a stock issue, there is no legal restriction, and so it offers greater flexibility to the company. A second decision-making factor is the impact on ownership. If a company raises money by selling common stock, it is essentially accepting new owners. Since each stockholder can vote, each can influence company policy. Yet an owner of bonds does not have voting rights. A third decision-making factor is tax consideration. In debt financing, the interest on a loan is tax deductible. A fourth decision-making factor is what is owed in each situation. For instance, in equity financing, there is no promise of repayment. With debt financing, there is a long-term financial obligation. The money must be repaid. Now suppose a company recognized its markets were expanding. If it could increase productive capacity, it could receive a lion's share of that expanded market. It requires new equipment and an infusion of capital to buy it. What should it do? Use debt or equity? Let's examine debt in the form of a long-term loan. Since the outlook for the company is good because markets are expanding, the company could repay the loan. But there would be certain legal obligations. A positive point, the company would avoid relinquishing ownership or any control, and the interest on the loan would be tax deductible. Another option would be to sell common stock. There would be no restrictions on the company. It would impact ownership, and there are no tax advantages. In this case, the company does not want to give up any management control and can repay the loan, so debt financing is the better choice. Remember, every company's situation is different, but the decision-making process is the same.
We'll now visit two companies to see what considerations were involved in their decisions and what impact those decisions had on their companies. First, we will visit again with Paul Nichols, Vice President of Finance, Quality Components Incorporated of Addison, Texas. And as you may recall, we visited with Mr. Nichols in a previous program on short-term funding. Well, Quality Components is a rapidly expanding distributor of specialized products to the semiconductor market. And we are also returning to revisit Steve Miller, Executive Vice President of Finance and Administration for the Chrysler Corporation. Let's start with you, Mr. Nichols. We've been focusing our attention on long-term funding. What needs for long-term funding have you had at Quality Components?
Okay, we have had a number of specific needs. They primarily, I would say, end up coming back to 3 basic areas. Acquisition of major capital-intensive type of investments. For example, we'd be talking about plant, equipment, land, automobiles, things of this nature. That's one area. Another area that we have had to utilize is in buying out certain principles of the business. It's required rather large cash infusions. Additionally, another area that has caused us some concern also is the expansion of the business on a long-term basis. You've got to be able to plan for that growth. It's got to be orderly. It's got to be recognizable that it is part of an overall master plan. It's not just something that happens to come along.
What sources of long-term funding did you use in solving these problems?
Well, Alex, we actually ended up utilizing debt, both short and long-term, I might add. We felt like we had more flexibility by going that way. In addition, we investigated a number of other alternatives, one of which was an equity approach to the situation.
I wonder if you might explain that approach in some detail. Why this particular approach?
Alex, we came up with a package that we felt fit our needs very well, and that was the primary concern, was being able to accomplish the objective with the package and still facilitate the long-term objectives of the corporation. Specifically, we ended up doing a combination of receivables financing up front, which gives us short-term money on a very quick turn. We then went with longer-term money tied up in our inventory financing, and some asset financing was involved also. The thing that we felt we accomplished by going in this direction was that we have a vehicle in place that will allow us virtually an inexhaustible supply of capital into the future, assuming that we manage our assets well.
When you came up with this approach, what factors contributed to the decision?
Alex, there are a number of different factors that come into play here that we try to consider. Some of the more important ones are obviously the effect on our financial ratios, on our balance sheet on a long-term basis. Are we impacting that favorably or negatively? How do we look to people who are creditors to us, whether it be our bank or suppliers or whatever? Those things are major considerations. We obviously looked at the cost of money, the interest rate. I might add the cost is more than just the interest rate. There are other factors to be considered in the form of hidden costs. Some of those things might be, are there compensating balances required by the financing entity? Do they have any stipulations or restrictions on us from the standpoint of payment of dividends and bonuses? Are there restrictions or limitations relative to working capital, net worth, debt-to-equity ratios? Those areas obviously are of a concern to us also. In addition, other areas that we put a lot of emphasis into, just the debt itself, the carrying cost of that debt, how is it going to impact us from the standpoint of our balance sheet and of our operating results long term? That interest expense can get to be very significant over a period of time to your operating results. We also are very interested, obviously, in the tax consequences of what we were doing. Other factor that we considered very strongly was the current conditions in the capital market. Did it look favorable now as opposed to 6 months from now or 3 months from now or what? So those are all major considerations that we tried to look at.
Mr. Nichols, just for a moment, looking back, what do you feel was the impact of your choice of funding on the company?
The impacts, Alex, were many, but we think they were very favorable to the corporation, to the corporation's overall long-term objectives. And I stress long-term because, again, this is part of an overall long-term plan. What we did basically was to provide the capital that was needed, which will facilitate our growth, which will allow us to go from point A to point B. At the same time, we kept a certain amount of flexibility in the picture relative to how we want to do that. We have avenues still available to us for future financing needs, which was a consideration. We think, by and large, that we've accomplished the objective, and the outlook is very promising for us from our financing package.
Well, thank you, Mr. Nichols. It was good of you to let us visit with you again at Quality Components. It's been very constructive.
My pleasure. I've enjoyed it very much, Alex.
I think we understand now that Quality Components required long-term funding to finance growth and expansion. Now, Chrysler Corporation had an entirely different need. The need, back in the late 70s, was not long-range growth and prosperity. The funding was necessary for survival. As Chairman Lee Iacocca has said, we came within a whisper of bankruptcy. Before we talk with Steve Miller, let's review what happened to Chrysler just a few short years ago.
It began in the city of Detroit when the century was young. The automobiles rolled from the assembly lines like chariots for the gods of the time, the newly affluent, free-spending, highly mobile inheritors of the industrial age. Here was the world's first society ruled by its middle class, a nation of people who would be molded largely by a love for a wheeled machine. Their names are a vital part of our folklore, their mystique a part of our psyche. Ford, Chevrolet, Dodge, Plymouth, LaSalle, Chrysler, Kaiser. The years rolled by. The cars rolled from the line in what seemed an ever-growing and never-ending river, bigger, faster, more luxurious, more expensive, more powerful. To Detroit, it seemed our love affair would never end. So sure were they of our constancy that they were blind to some strange and troubling things happening beside the road. There was evidence the world's supply of fossil fuels was running dangerously low. Yet our cars continued to guzzle enormous quantities of this diminishing resource at a dramatically increasing cost to the consumer. More and more Americans opted for the smaller, more efficient, and often less expensive foreign imports. Toward the end of the 70s, variables in the economy impacted the auto industry. Taxes and inflation were convincing the consumer that perhaps he'd get along for another year with the old Ford, the old Chevy, the old Chrysler product. And by 1979, the industry was mired in its worst sales depression in 50 years. Of the big three automobile companies, Ford, Chevy, and Chrysler, it was Chrysler Corporation which felt the slump most profoundly. Chrysler not only had to deal with the external problems which faced the automobile industry overall, but also it had its own internal problems to deal with. Because of marketing, production, and financial decisions made by Chrysler management, Chrysler was in serious financial trouble. Beginning in the 1960s, Chrysler decided to cut its capital expenditures in this country and expand its foreign operations. As it turned out, those foreign operations did not do well. Management decisions to lay off 80% of its design and engineering staffs led to costly design errors and limited the company's ability to meet competition as well as regulatory requirements. In an effort to improve short-term profits, management made other cost-cutting decisions, ultimately damaging long-range profitability. When those profits were needed in the middle and late 70s, they weren't there. And in the face of these circumstances, Chrysler management chose to continue to pay stock dividends even though profits were down and the company's debt was growing. Meanwhile, Chrysler based its production plans on speculative sales forecasts instead of orders from its dealers, the standard practice in that industry. And sales dropped as the prime market of blue-collar workers was hit hard by the recession of the late 70s.
When you tour this plane today...
Lee Iacocca took over as chairman of the board of Chrysler in 1978, just in time to see the losses for the following year total $1.1 billion. He and his management team began the long fight back. Industry and analysts have since said of Iacocca, he is for Chrysler what Winston Churchill was for England. He provides the roar. Chrysler management came up with a plan to save the company. Operating costs were cut by reducing the white-collar payroll. The union was encouraged to accept a cost of living increase freeze, as well as a freeze on benefits. Suppliers were persuaded to delay collections and to cut their prices 5%. Lenders were persuaded to convert loans to preferred stock in the company. But the basic part of the plan was the restructuring of its $4.4 billion debt and the acquisition of a $1.5 billion federally guaranteed loan. Until July of 1980, the fate of the company hung in precarious balance. Bankruptcy seemed just a day or two away. After months of maneuvering and negotiating, the bailout was signed by President Carter. And in July 1980, the first check for $497 million was handed over to Chrysler. Iacocca said, "We're in business to stay. We'll give everyone a run for their money."
As a journalist, I've covered a great number of stories in the world of business, but I don't believe any had the inherent sense of drama and suspense as did the Chrysler adventure of the past few years. Mr. Miller, you were there. You lived the adventure, so maybe you can help us understand just what went wrong. For instance, what was the specific long-term funding problem faced by Chrysler?
This company in 1979 recognized that it no longer had access to the public markets for capital. There was no one who would buy Chrysler stock. It had sunk to about $3 a share. And there was no one who was going to lend Chrysler money in the kinds of quantities that we would need to keep up with our product programs.
When you realized what was happening, the gravity of the situation, what did you do?
Recognizing this, and recognizing that we had 600,000 jobs across America in our own company and at our suppliers and dealers, 600,000 jobs at stake, that caused us to go to Congress to get the Loan Guarantee Act passed to give us the government's credit backing for over $1 billion in debt financing so that we could get through our crisis and get our company back on track.
The need for the funds was obvious. But once you received the funds, the government-backed loans, how did you use the money to solve Chrysler's overall financial problem?
The fact is that Chrysler had a plan to fix the company, get it back on a profitable track. We executed that plan. We cut the costs, made this company more efficient, overhauled and modernized the product range. We basically doubled the fuel efficiency of our products. We now have twice the productivity that we had before in terms of output per man hour. So by becoming more productive, more profitable, with a better product range, we were able to generate the cash to pay off those loans that were backed by the government, and the Loan Guarantee Act is now history. We have established ourselves, therefore, as a credit-worthy company, and we are now able to go back to the public credit markets for both debt and equity capital.
Okay, Mr. Miller, let's go back for a minute. Once you turned the corner and were able to pay off the debt, then what long-term funding problems were still confronting you?
Okay. Well, as we were beginning to see light at the end of the tunnel, at the end of our period of loan guarantees under the federally sponsored program, we could see that for the long term that Chrysler Corporation would need a major new infusion of equity capital.
Why equity capital? Why not a long-term loan or bond?
Equity capital is the most stable kind of capital because in bad times you don't have a big interest burden to pay, and it's there forever. You can count on it. You only have to pay dividends to the extent you're making profits. And we just needed more equity capital to provide stability for this company so that it would never again teeter on the edge of bankruptcy and put at risk all of the hard work of all the people who work here. So we went in the spring of 1983 to the stock market and offered for sale and sold 26 million shares of stock that brought us nearly $500 million of new equity capital. And in one overnight change of this company, we got enough equity capital to assure that stability.
Well, in addition to stability, have there been any other results?
The public markets have responded favorably. Our stock prices have gone up. Our ability to get debt capital where we need it has gone up because people now believe that this company is stable and is going to be in business for the long haul.
When you decided on a stock issue, what did that involve?
It was a complicated transaction that involved the participation of banks as well as the investment bankers on Wall Street. Now, fortunately, we had one of the premier firms on Wall Street, known as Salomon Brothers, who had been working with us and advising us all through the period of the loan guarantees since 1979. And they were very familiar with us and with our history, and they could see what was happening to this company, and they were therefore willing to put their company's prestige behind a stock issue by Chrysler. But one company couldn't handle a transaction of this size alone. This turned out to be the third largest stock sale by an industrial company in the history of Wall Street. And to get that kind of clout, we really had to reach out and touch virtually every firm on Wall Street as a participant. Salomon Brothers was the lead manager for this deal, but we had all of the major houses were participants, and in fact we had about 200 brokerages across the nation in total that were involved. And that was desirable because we wanted to get the word out to investors across the land that Chrysler was back in a big way, and it worked. We got the attention we needed, and we've been having no problems ever since in raising the kind of money we need to run this business.
Well, without doubt, the Chrysler refinancing stories had a happy ending. I might add that Chrysler's controversial government-backed loan was paid back in full, and it was paid back ahead of schedule. You and your company are to be congratulated. Thank you for your time, Mr. Miller. I enjoyed it.
Well, Alex, thank you very much.
And so we have the tale of two American companies and how they used long-range funding to deal with the best of times and the worst of times. Comparing the experience of Quality Components and Chrysler demonstrates that approaches to long-range funding depend on the needs of the organization. Quality Components needed funding to take advantage of an opportunity. Chrysler needed it to buy time, to buy survival. There is no typical scenario, no typical solution, even though the decision-making process should consider the same factors in all situations. Until next time, I'm Alex Burton, and this has been The Business File.
The preceding program is part of a college credit course.